All right, today we're doing something a little different. We're putting on our hedge fund hats to pitch an investment case for one of the world's most complex companies, Reliance Industries. We're going to focus only on what we think moves the stock over the next couple of years.
Okay, let's just dive right in. If you just glance at the headlines, the full-year results for Reliance look incredible. I mean, record everything. But if you're doing your job as an analyst, you look one layer deeper. You look at the last quarter. And that is where the story gets really, really interesting and raises a huge question for any investor.
And this, right here, is the puzzle we need to solve. How on earth does a company post a massive 18+% jump in annual profit, but then see that same profit drop almost 9% in the final 3 months? This contradiction, well, it's everything. Figuring this out is the whole game.
So how do we solve it? Well, first off, you have to stop thinking about Reliance as just one single company. It's not. It's really a collection of several massive, totally distinct businesses, and each one has its own story. Let's break them down real quick. First up, you've got the monster, Jio Platforms. With over 500 million subscribers, let that sink in. And look, this isn't just a phone company anymore. It's basically the digital front door for a huge chunk of India. They control massive amounts of data and access. It's an incredibly powerful, high-margin asset. Next, there's Reliance Retail. You see the 20,000 stores and think, wow, that's a lot of stores. But honestly, the stores themselves, they're almost secondary. The real gold is the network. 387 million customers, nearly 2 billion transactions a year. It's a consumer data engine like no other. And then, of course, you have the original cash cow, the huge oil-to-chemicals business. For decades, this was Reliance. It's a global giant. But here's the catch. It's super cyclical. It's tied to global commodity prices, which is exactly where a lot of that volatility we're seeing is coming from. Okay, so now that we know the pieces, let's talk about what the market is focused on right now. What's the consensus view? The bear case that's driving that weakness we saw in the fourth quarter. This is it. This is the number that's spooking everybody. Retail profit margins are shrinking. Now, a 30 basis point drop might not sound like a lot, but at this kind of scale, it's a big deal for profitability. For your typical analyst, this is a huge red flag that screams slowing growth or a nasty price war. So the bear case, the easy story to tell, is pretty simple. The old energy business is shaky, and the big, new, shiny growth engine, retail, is getting less profitable. But we think that's lazy analysis. It's missing the real story completely. Which brings us to our variant perception. This is the key insight, the thing we think the market is just totally missing, and it's the entire basis for our investment thesis. Okay, remember that margin dip. This number right here changes everything. See, that dip isn't a sign of weakness at all. It's the cost of fueling an absolutely massive, over 300% year-on-year explosion in hyperlocal orders. They are spending money to build a moat in last-mile delivery that no one else can cross. And you don't even have to take my word for it. Just look at what the company itself is saying. Leadership isn't managing the business for one quarter's margin report. They are investing heavily right now to build a platform that's going to churn out profits for the next decade. They're sacrificing a little bit of profit today to build an absolute fortress for tomorrow. So let's just lay out the core of our thesis. We believe two key businesses are being fundamentally mispriced. First, retail, where the market sees a problem with margins, we see a brilliant strategic investment. And second, the new energy business, which the market gives almost zero value to today. We see it as a massive free call option on the entire future of India's energy transition. And again, this isn't just us making stuff up. The chairman himself has basically told the market that these new gigafactories aren't some side hobby. He's saying this is going to be a central growth engine for the company, right up there with Jio and retail. Okay, so having a contrarian view is great, but it's useless unless there's something that's going to make the rest of the market agree with you down the line. So what are those triggers? What are we watching for? Over the next, say, year and a half, we've got our eyes on three big things. First, the IPO of Jio Platforms, which they've already said is coming. Second, that inflection point when the retail margins start growing again because those investments paid off. And third, just concrete updates from the new energy business. Any one of these could be the spark that forces the market to wake up and re-rate this stock. All right, as an analyst, you can't just have a view, you've got to put probabilities on it. For us, the bull case, where the market finally gets the story on these new growth engines, we're putting a 70% probability on that outcome. The bear case, that the retail spending doesn't work and the old energy business keeps dragging, we see that as a 30% risk. So when you weigh it all up, The conclusion for us is pretty clear. It's a buy. Our thesis, when you boil it all down, is simple. The market is staring at short-term costs and getting distracted by quarterly noise, while completely missing the long-term dominance being built in consumer tech and the huge, basically free optionality in new energy. And that really leaves us with the big, final question. We've laid out the value that we think is hiding in plain sight, but is the market ever going to get past the complexity of this giant company and actually see the transformation that's happening right under its nose? Thanks for joining this explainer.